We are waiting for the FOMC drift to kick in. Hasn't happened yet. That's the tendency for the market to move up in the day before the Fed meeting. But very defensive tone today. So let's take a look at the market here. You see the consumer staples up. Procter had very good numbers overall. So Procter's up, Coke's up. Defensive here, as I mentioned. REITs doing well. Semis, again, growth indicator slightly on the weak side. Industrials also slightly on the weak. Your Cummins, your Caterpillar, big global industrials, a little bit on the weak side. Just want to point out the transports notably weak within the industrials. Ryder had some lowered guidance there, so the trucks generally are on the weak side for today here. We're halfway through earnings season. More than 250 companies have reported in the S&P 500. Where do we stand so far? Well, 76% have beat. That's about average for the last 4 quarters. So let's just say things are not unusual in terms of how the numbers are coming in. We have, this is the most important thing, no collapse in the second half guidance. Flattish is the word I've been using for more than a month. Flattish is essentially what we are seeing. That is better than dire predictions of 2 months ago in May when they said numbers were going to come down because of global growth slowdown. That hasn't really happened, although there are some exceptions. We don't have clarity on global growth. We do have central bank backstop, and that's the main reason the markets have been holding up so well for the last several months. When I say flattish, what do I mean for flattish? Here's what flattish looks like for 2019 earnings numbers. Basically, you're looking at up 1.6%, flat 0.6%, down 0.6% for the third. This is what flattish looks like. Hope here that numbers will get a little bit better in the fourth quarter. But you see what I mean. Let's not quibble about a percentage point or two. This is flattish numbers for 2019. Here's what's important. Domestic versus foreign sales. Companies that have more of their sales outside the United States generally are reporting lower numbers. This is a FactSet number here. I think it's very important. Companies that have more than 50% of their revenues outside the United States generally seeing earnings down 13%. Those that have more domestic-oriented, less than 50% of their revenues outside the United States, more domestic-oriented, they're up 3%. This is a very, very wide difference. This is from FactSet. Sometimes the numbers are a little different than Refinitiv, but you see that difference, and that's the global slowdown. That's the tariff and trade war that we're seeing. So clearly an impact, but not bringing the overall markets down because of the strength in domestic sales here in the United States. One thing you got to be very careful about is very expensive stocks that are out there, high multiple stocks with commentary where the growth isn't as strong as people thought about. I'm talking specifically today about Under Armour. So what looks like good news, there is good news. The numbers were okay. They're actual reported numbers, and they affirm their full-year earnings. Well, you say, hey, that's the most important thing. Isn't that what matters? Yes, but North American sales, and this is their big market, probably 65% of their revenues, North America, down 3%. Uh-oh. We were expecting flat to slightly up there. And the guidance for North America sales, a slight decline, that's not a very good observation. And so that's why you see Under Armour today, put Under Armour up here, down so dramatically here. You might say, holy cow, down almost 20%. How could that happen with revenues? Well, it's very simple. They're expected to make something on the order of 35 cents this year, 35 cents. You divide that by 24, which is what the stock was, and you get a multiple of 70. Folks, you do not get a multiple of 70 times earnings when your primary revenues in your primary market are declining. The market won't give you that kind of multiple. You want to see primary revenue going up, primary market revenue going up, not down. And that's why we're seeing a decline here. My point here is there's a bunch of expensive stocks that are darlings and have been for a while out there. And when you start talking about slower growth, they're not going to give you the benefit for the Dow. Right now, the Dow down 96 points.